Let's talk about Scots and how they're having issues with inventory and how that's impacting the company and the future of the company. Now, Scots is known as Scots Miracle Grow Company, ticker SMG. If you look at their chart over the 5-year period, they hit a high of around 249, 250 in March 2021. And we see how far they've fallen since then, right? So their all-time high was around 250 in March of 2021. They're trading now currently at around $53. And here's a really good article from the Wall Street Journal. It talk about from shortage to glut, Scott's Miracle Grow was buried in fertilizers. They have an inventory issue to where there's too much inventory based on demand. So what we're dealing with is a surplus, right? And Scott's doesn't want to do what most people would think you should do in a surplus. They want to ride it out. We're going to kind of talk about that, right? So they went through an expansion phase and they expanded too far. And now they're realizing now they have to contract to deal with the fact that they expanded too much. Okay. So months ago, Scott was bracing for the biggest summer ever. Now, Scott's sells a lot of lawn supplies. And if you, especially from up north, because I had to realize this because I'm from Florida, where we don't have the seasons like everybody else has. Most people start working in the yard springtime, summer, and then the lawn goes dormant in the fall and the winter, and they ramp up. So a lot of lawn supplies and things of that nature are sold on the seasonal pattern. And even in Atlanta, you start hearing commercials to start buying lawn supplies early spring. In Florida, you never hear it because we don't really have that issue of especially in Central South Florida, of a big yard die-off. You get a little bit, but you don't get it massive like you get in other parts of the country. Therefore, they're very much in a seasonal business. So they do the majority of their revenue a certain time of the year. And then in the winter, they do a lot less revenue. Why? Because most people are not looking to buy lawn supplies in the winter because they're inside the house. They were bracing for the biggest summer ever. So after 2 years of struggling to fill the stores, the company started ramping up a lot of production to deal with this consumer demand for lawn seed, fertilizer, other garden products. Then they started doing a lot of investments in manufacturing capacity that were paying off as, you know, the usual rush from May orders from retailers looking to replenish their stocks. We talked about, started getting in the spring, started getting a lot of orders to make sure that the garden area is looking nice and robust, right? Because it's a seasonal business. But the orders never came. And by Memorial Day, this particular CEO knew that the company was in trouble. So Scott's currently has cut 450 jobs, around 6% of its workflow since May, said more layoffs are coming. Manufacturing has slowed down. They're losing cash and nobody's getting bonuses. Now the company's in a full-blown crisis mode, okay? So Scott's was caught in a bloated inventory situation, just like Walmart, Target, Home Depot, and the companies did not foresee the sharp reversal in buying behavior that has taken place in recent months as shoppers squeezed by inflation, cut back on furniture, electronics, and other goods, and shifted back to travel, food, and fuel. Now, this is very interesting because we saw a lot of people talk about pent-up demand. And when we open up, we're going to get a lot of pent-up demand that was, wasn't able to get access to because of the pandemic. And I said, cool. Now, once the pent-up demand is extinguished, now what? So now once everybody gets satiated, because, I wasn't allowed to go to the movies because of the pandemic. So now we're saying we're lessening, or we're softening the restrictions on you being able to move around. Everybody goes to the movie. And then once they get satiated, because I can finally go to the movies anytime I want to now, what happens to those particular industries or those particular sectors? And we saw a lot of that. And the pandemic changed people's behavior to where they were doing things they normally would not do. Why? Because I was at home. And we saw remodeling, home repair, yards really started to become really, really big verticals. Why? Because people were just sitting at home and they had nothing to do. So they said, let me go and focus on my house. So Scott was in the middle of an active selling season when COVID-19 shut down much of the global economy. We remember that because COVID started getting really, really big in like this midsummer. So early in the pandemic, manufacturing operations were deemed essential because fertilizer is important to food supply, and retail stores that sold the product stayed open, but they weren't able to really do the type of production that they wanted to do. They were paying a 50% premium, but then if somebody got sick, they sent the whole shift home. So they changed from 3 8-hour shifts to 2 12-hour shifts to try to make sure we can use people while they're here and, get production back up. We talked about before, people started guarding more than ever. Why? Because people were just sitting at home. So they couldn't feel demand. So now people are buying a large amount of fertilizer, a large amount of garden supplies. We can't meet demand. So when the quarter ended, it closed at the end of June 2020, sales in the consumer business, which make up around 2/3 of the company's total revenue, were up more than 20%. And then empty shelves indicated that Scots could sold even more. So what they did is they believe they missed sales. So our best guess is we missed about 200 million in sales because we couldn't deliver. And we picked up 10 years of growth in that year, the first year of COVID. And this happened to a lot of companies. I was listening to a call of a particular logistics company, and they reported, I think, that second or third quarter after COVID, after the pandemic. And what they said was that we're 3 years ahead of sales objections. And the challenge is that, well, it's the situation that created that. When the situation no longer exists, we're going to see sales start to go down, and that's just what they're experiencing. So by next spring, April 2021, Mr. Hagedorn told investors that the rapid sales growth meant inventory was below an acceptable level, which meant that leaving sales on the table and frustrating retailers. So they're not able to get sales, and retailers are upset because people are coming in looking for this product. They're not able to buy it, which means they're also losing sales. So what they did was they started investing in capital expenditure for production. So it doubled to 52 million in 2020 and then rose to 78 million in 2021, according to S&P Global Market Intelligence. And it's really to try to fill that unmet demand or that unfulfilled demand that was out there. But because we didn't have production capacity, we couldn't fill it, right? And that was a gamble. And why was that a gamble? Because what happened when the demand no longer exists, right? So you're doing capital X, or you're doing CapEx to meet demand. But what happens when the demand no longer exists? Do you believe this situation is going to stay here all the time? And what happened is, so stores asked why they reduced orders. So over time, we talked about before, because buying habits changed, stores started to reduce orders, and they said they planned to carry lighter stock, because stores, what they don't want is to buy products from somebody and they sit on the shelves. What does that mean? We could be using that shelf space for something else, because shelf space inside a store is very, very valuable. That real estate is very valuable. So if we're putting products on store shelves and they're not moving, it means we could have been putting something on those shelves that would move, which means not only are we not able to sell that, we're missing out sales for something else. So what do? They just don't put new orders in. So retail orders for more than 300 million below expectations for May, but Memorial Day was like, turn everything off immediately. We need to preserve money. So the big jump in inventory tied up cash as the end of June. Scots had just 28 million in cash, down from 244 million at the same time. If you're not driving the sale, so if you spend money to produce the product, it doesn't sell, or you're not getting orders for new product that you can sell it to retailers, the problem is you don't make money off what you spent, which means what? All your money's tied up in inventory. And this happens to people that deal with physical inventory. So I used to run a street line company before. I didn't do on-demand printing. I had a fulfillment company. I had a fulfillment company. I had a printer print my shirts. And then what I did was I sent it to a fulfillment company, and I let the fulfillment company ship them out. But my capital was tied up into printing. The fulfillment company got paid when I got paid, but my capital was tied up into printing the actual physical shirts. Therefore, if the shirts didn't sell, I can never recoup my capital. And when you're dealing with a physical product, a lot of your capital can be tied up in inventory, okay? Unless you're able to do some type of deal with the manufacturer. But if you're manufacturing on your own, where you're just buying the raw materials and you're doing manufacturing, you're on the hook, essentially, to invest in manufacturing, and you got to try to get that out on the back end when you actually sell the product that you're producing. So one benefit is that existing fertilizer inventory won't spoil, so it can be sold off in the next season, and the company doesn't want to cut prices. So this is really important. They don't want to cut prices to move it. Therefore, their attitude is that because it won't go bad, it won't spoil, we can sit on it and wait for the market to turn around. And so hopefully that works for them. However, Ms. Hagedorn has stated that more job cuts are coming, along with the cuts that begin in May, and then also not hiring new people. So they did a hiring freeze, but they're also going to fire more people. And another change we're going to talk about, because they go into the whole history of the company, that's really not that important in my opinion. So in late August, Scott said full year cash flow would be negative 275 million to 325 million, compared with the projection of negative 150 million in early August. So they increased negative cash flows. And the company also disclosed that the finance chief had left the company. Okay. So in closing out, what the CEO says is that he wants to remold Scots to reflect their own thrifty entrepreneurial ways. He says his current mission to cut costs and keep the company leaner in terms of inventory and debt is a return to those ways. So what we saw with this particular company, they went into an expansion phase. Now they're going into a contraction phase. And businesses do this all the time. When they think business is good, they're worried about losing sales or not making as much revenue as they could. So they spend money to expand to gain more revenue. As the market changes, they start contracting to save money. So now they got to contract, get their budgets and things back in order so they can set themselves up for the next expansion phase. And it just goes back and forth. And so therefore, as an employee of a company, you don't control a lot of these decisions, but you can be impacted by them. And therefore, when business gets good, they're giving you all the hours you need. They're giving you overtime. They may even be giving raises and bonuses. When business starts getting bad, they start cutting people off. They start shortening hours. They can make the workplace not be that, I would say, not be that, I don't know what the proper word is, where like you don't want to go to work. They can make the workplace be kind of negative to make people want to quit so they can get more people off the payroll because we don't have the same amount of work that we had previously. So we don't really need all these people anyway, but we don't want to fire you because then now we got to pay unemployment. And so these are the kind of things that you see. Therefore, if you're a person that you want to go into business, you really got to understand that your forecasting of the market is really, really important because not only does it impact your business, but it can also impact the people that are working for you that are dependent upon you making correct decisions so they can support their family. So I hope you got some value from it. David W. Williams, also known as Diamond Dave. I'll talk to you later.